Well, Eternal in today's trading session have hit a record high. In fact, ever since the company reported the numbers, the stock has rallied about 15% plus. And that, if you look at the reported numbers, then you'll be wondering why. Because the revenue has grown 70%. That's great. The EBITDA has fallen 35%. Margins have contracted to 60 basis points. And the net profit has fallen 90%. Now, here's why. Because a couple of things that the management spoke about are telling you that the worst is behind. One, year-on-year growth has bottomed out for the food delivery business, which implies that it will only improve from here on. And near-term, quick commerce margins too have bottomed out and they will improve from here. So let's take the food delivery business first. Over the last many quarters, the revenue growth had been coming down, and for the first time between Q4 and Q1, the revenue growth has stabilized. This is gross order value growth has stabilized at around 16%, which the management believes is the absolute bottom. And from here on, they are expecting growth to resume. That's a positive. The second part, Blinkit, which was supposed to be the growth driver of the company, continues to be the growth driver, so much so that the revenue growth of 154% has actually made it the largest revenue component in the overall business. But the problem over the last few quarters was EBITDA loss increasing due to competition. Out here, the losses have narrowed quarter on quarter, and this despite the company continuing to expand. So if you look at it, they've added almost 243 stores in this quarter, total stores going all the way up to 1544. And this, while doing so, the losses quarter on quarter have narrowed. So the Blinkit loss trend comes up for you from 178 crores, it's narrowed to 162 crores. And the management believes that in the near term, it's actually likely to see margin improvement. So two growth drivers of the company, both of them fairly in place. Which is the third one? It is District, where the management sees over the next 5 years, it could be an annual $3 billion revenue company with $150 million in annual adjusted EBITDA. So the third factor doing extremely well for them as well. The question, what about the money? Well, in the fourth quarter, they had seen a quarter-on-quarter decline in their cash balance. That too seems to be stemming right now. From the fourth quarter to now, the cash has marginally increased or cash burn has reduced as well. So all these factors doing well. The stock, which was off its highs, has now moved higher. The next big trigger is because it is now a largely domestic-owned company. They will own inventory in Blinkit as against third-party sales, and that could increase their margins in the quick commerce business by about 1% as well. And when Blinkit rise, it's not just Blinkit, because we have Swiggy, which is trading higher on the back of Eternal's performance, and it trades at a 45% discount to Eternal, so that stock is higher. And secondly, InfoEdge, which owns about 13% stake in Eternal, worth nearly 38,000 crores or 40% of its market cap, doing well in today's trading session as well. But the data point or the picture that caught my eye was that on the shareholders letter. It had three businesses, all of them with clear positioning. Zomato for Eternal, aaj kya khaoge? District, aaj kahan jaoge is the going out business. And Blinkit, finally, aaj kya mangwaoge? Three business propositions, all of them clarified in their shareholders letter.
Thanks for tuning in to CNBC TV 18, and for more news and updates, follow us on all the social media platforms.